What I wanted to do right now, besides the organizational change today, is to show you what happened yesterday. We should do a recap. Let's just split this off here. We should do a recap what happened yesterday, and maybe it is really new to you or might be new to you, and we will discuss it in the next 1-2 hours a little bit more intensively. Is that you learned that Bookmap and especially TradeFinder is an excellent approach to fine-tune your trades to get the best risk-reward ratio. We have discussed the volume spike, sweeps, absorption, icebergs, and the liquidities concept of the market. At the first day, and that's again important, I think is I know is to have a look at the auction and understand how prices are made. It doesn't matter whether we are on the exchange here or if we are or we are buying anything else. It doesn't matter what. We need to have liquidity. There must be a person, an individual who is willing to sell something to us or to buy something from us. That's a normal principle. That's really nothing special. But I think and I believe that we should keep in mind that at the exchanges we have exchanges we have the same mechanism, and this mechanism can help us to understand what the market is doing, who is leading, are the buyers leading or are the sellers leading, how they are hitting the bid. Is there a certain support on bid, for example? That might be indifferent, that might be high liquidity, that might be, as well as we discussed yesterday, icebergs who are trying to support by higher volume or higher liquidity a certain price level, or on the ask side where we can see the resistance, liquidity resting on ask, for example, and resisting the market and trying to bring to a break or halt, and then pull back the market back or pushing the market back. Yes, Christoph, I can do so for the Ninja Trader. And then we discussed the options, and my comprehensive view of the market is, I'm like the word holistic, is that we just not have a look at a certain chart with what chart not on certain chart, and as well the indicators, what we have installed and what we are watching, but we should have at least an overview of the overall I'm a little bit down. It's a little bit hard today. I don't know why. The overall market. It means by that saying that, I mean that we should have an understanding, even a very a good overview about the markets, about option market maker who are driving the market, about the hedge funds, and what happens on the left and right side of us in the market. That's my approach to show you that, and we discussed, for example, for the ES, and as well I will add, when I have a little bit more time, the same structure for the NQ, because we have the QQQ for the NQ, and we have SPY. We should look we have the tools like from Spot Gamma, the Gamma levels. We have the tools which are for free, the institutional levels I'm providing nearly every day when I'm around. Then we have the volatilities. You remember, the option maker must keep the exposure not low but at zero, and they have to sell, and they had to hedge their positions. We have the gamma. Gamma is when delta is the speed, then the gamma is the acceleration in the options market. We have the Warner, which is the volatility. the implied volatility of the market, and we have the charm, which is the time. So we talked about that the options expire at around mid of month mid, around 15, 16 or so something like that, and then the market is on its own for several days until the options are again interacting with the market. And mostly, and that's the point, maybe to what I wanted to say with the introduction of the electronic traded markets, the E-mini, which was 97, is simply to give us the opportunity to trade with a low budget, with the low budget these markets as well. And nowadays we have the micros, as well. So that was the overview, and then we started to dive in a little bit more after this, the understanding of the brief introduction. It's really a really short and brief introduction into options. Then to understand that we can see gamma, which is, or the institution levels, which worked perfectly yesterday. That we see that we have static information about the market, and we have live or vivid actual information of the market based on the SPY. You see that in front of you see it on the screen I'm sharing here. We see you have the SPY, you have the VIX, that's the volatility index. We have the VXX, which is the ETF UVXY, which is the stock or ETN, and then HYG, which is the high yield bond for the high yield corporations. And all this mixture gives us an excellent overview of the status of the market state and what the market is likely to go to do. And we will discuss that. Welcome, David. Welcome, Argo. Hi, Alexander. Welcome back to our session here today. I mentioned we have an organizational change. I have to leave at 12 p.m. Eastern time. That means 6 p.m. I have an important appointment. I can't miss today here. So, but we will tomorrow be together all the day. And trading. We have still a little bit to go with the theoretical explanations of the minor entries. We will have a look at. And I'm just talking about what we have, a recap. It's a short recap about what we have discussed the last 2 days, so Monday and Tuesday. And that might be exciting. It might be unbelievable for you that institutional levels are working maybe 80% of the time. You can check that every day. You can make your stats about them and what they are representing. And it might be even unbelievable that you can have a simple chart and understanding the market direction without struggling with any explanations. There's a green bubble, there's an iceberg, there's a stop run, whatever. You don't need it at the first. You should simply understand what the market is doing and where the market is heading. And when we discussed that yesterday evening before we closed the session, the market was in the state, and I think I mentioned that this move up. I hope you can see my screen. You can understand everything I'm saying here. Yeah. Okay. Great. So just give me an Y. Okay. Good. Hope everyone is on board here. I'm excuse me, I need a little bit more adrenaline today to come into this into the topics here, into the subject. You remember that we talked yesterday about this move. So when we talked about VIX, VXX, UVXY, and HYG, then you see you see a divergence here. So the VIX is dropping, the VX-axis dropping, and the VXY as well as was dropping here in yesterday's chart. Then the market was simply not the market showed strength today. Yesterday. The market shows strength today. It doesn't matter what the volatility index did here at that time. It was 7 my time. It was 1:10 p.m. Eastern time here. It doesn't matter what the volatility index did. The market went up, but very slowly. You remember that I tried to annotate and showed you that the market trades at different, or can trade on trades, not can, but as well trades on different with different speeds. That means very high here. Disregard this. Just let me clear. Okay. This speed is very high. It goes for a certain time. You see, this is the time axis here. It goes very, very fast. It's not 90% here like on sweep. Like a sweep is always a 90% move, and that implicates that the market is really strong here. So, and the volatility drops. That's the point. But you see what happens then after this exhaustion at these points here. Market started to grind up very, very slowly. So when we compare the time the market needed to trade from here to here is a total different time than the market needed to trade took to trade from here to here. That's a completely different picture. And the interesting point, though, I said, and that was, I think I left. Yeah, I left this price alert lines on my chart here. I left them on. So that was this situation where we got a volume spike here. It wasn't a sweep, but a volume spike with high traded volume. And absorption, of course, here, that was really a warning sign. So the first warning sign. But anyway, it is hard if you're shorted here, then it might give you a few ticks back. But my experience is that when that happens, the pullback happens a certain time later. The pullback happens a certain time later. When we don't know, but we can say, okay, that's liquidity. And in this case, the institutional level was perfect at 47.10, and the price or the ES traded back into the next level, 05. But the most important, what I just wanted to discuss with you right now, to recap is, you see what happened at 3:30 Eastern time, half an hour before the close. You see what happened? Can you comment on that? You can use your microphones, ladies and gentlemen, so don't be shy. Use your microphones. Or write in the chat. You see my screen. You see my screen here. Let me annotate that as well. What I mean is this point here, that level. What does this mean? Wick started to go up, yes. And what does it mean? You see what happens here, and that's we will learn that. You will see that. I simply want to encourage you to use this chart. What happens when, I mean, that's hindsight. Not right now, of course, that's hindsight. But you see what happens here in the ES. The ES started to trade higher. Let me show you that on chart. That was this event here. So we saw the pullback at 10, and then it went back to 01, and then that was started higher. So the next assumption might be for some of you saying, okay, we reached the pullback. The next level should be as well here 05, maybe even 47.10, and going up. But suddenly, when we are just thinking, okay, this is a really bullish, strong market, suddenly that happens. The wick started to rise, to climb. Yes, David, thank you very much. That's the point. You will notice that. You will notice that every single day when the market opens. See another. Let's discuss or see another example here. Today happened right today. Clear our drawings. Okay. Pre-session. I don't know whether I can overlay this. Oh, we are not open. Okay, good. Market opens in 2 minutes. So let's discuss this before the market opens, because then it will be hard to see at the beginning. You see, that was the same time at 1:30 my time, 1:30 my time here, roughly. You see what happens. You see that that's another chart I'm watching. That's the ADD, the broader market index. That's the tick, and that's the SPX cash market here. And what I have on just a simple another, without any indicators. I don't like to have any indicators here, because I will talk about the suggestion I have to you, a motivation to you, I have to you, just to delete all indicators on this chart. Just watch what happens here with the VIX at 1:30, 1:40 my time here in the pre-session. What is the meaning here of where I hope you see my screen and where my cursor is. What happened here? Wick started to rise. The candles are green, yeah? Guys, use your microphones. Don't be shy. Discuss with me. It's all. This is really something invaluable, because when you see that, you go to your bookmap chart and you see starting this market breaking down or trading lower here.
Oh, it's have to go up for the ES to fall.
Yeah.
So I've noticed small amounts have no impact.
Yes, say it, Chris. Can you say it again, please?
How much does the VIX have to go up for the ES to fall? Because I've noticed small movements have no impact on the ES.
No. When it starts to trend, then we will talk about the minor or the finer entries today in the book map. When it starts to trend, be sure that the market here, the ES, maybe as well the in Q, but I can't comment on the Q right now. When the market starts to trend, you will see that the breakdown, that the ES breaks down. It goes lower than 96. You see liquidity at 92 and you see liquidity at 90. And this move, this up move, becomes stronger and stronger and stronger. And that means you can't buy that at the moment and at this moment until the WIX retraces or the WIX comes to a stop. Yes, the point is what I wanted to see. We should develop a major view of the market and a minor view on the market. That means by minor I'm talking about how to find the sweet spots, how to find the entries in the market. That's the one point. But with what I'm wanting to stress here is simply to watch the VIX for S&P, and I'm sure it's as well valid for the NQ and as well valid for the Russell. That means that the VIX is rising, and you will see that the ES is falling or dropping here. How much? It's hard to say, but we see that in this case, where you see this green candles here, Chris, we can't buy, we can't go against this market right now, because it's more, it shows us, it directs us to say, okay, the market will drop, and it dropped very hard. You see that, you will see that when you, I will motivate you to do, to rehearse that next week. Give me a few minutes, then we will talk about that. And that brought the ES in the pre-session down here. You see, there is no quantification of VIX must rise 1 point, 10, or 1 point, or half a point, on whatever. There, I didn't any quantification of how much must the VIX rise in order to bring an ES down. So I can't say that, but you see what happens here. That's the open. You don't need any other chart. You don't need any other chart, and we will rehearse that in. I hope so. I can motivate you to do that so in a few minutes, and we will do that tomorrow as well. David.
Hey Walter, if I look at the blue lines there, the start of your blue line yesterday.
Yeah.
The VIX was also rising, but the market still kept on grinding higher. So
yeah, that happens, and yes, exactly, and that's what I'm. Who was that? Who? Eve. Oh, so thank you, Eve. Yes, that's correct, but that's a divergence. Be alerted. Yes, I think maybe you know that, but I'm just saying that. So in this case, this is a divergence. When that happens, I'm totally alerted. Every red light, alarm signal, alarm sound goes on here in my brain and saying, okay, be very careful with the long positions here. When we see this actions here and the market starts to rise, or the S&P is going grinding up or trading up in this case, then you see VIX is rising. Be cautious with long positions. We will talk about the finer and minor entries, but that's a warning sign, guys. That's a warning sign. Every divergence you see in the volatility indexes is a warning sign. And as well, we talked about, and that's what I highly recommend. Let me find here. Where is my? You can use either the VXX. I like the UV, and you see, it's very clear. I don't need to see the ES chart right now. I don't need to see or watch the ES chart. I know from the beginning on that was a sell. Let me see if I'm right. Yeah. We see what is this, an absorption here, a very high absorption at 94. And then, excuse me, that's the chart. That's simply a sell. You have to sell ES. Can you show? Can you show all divergences on this chart? Which chart? I'm lost a little bit. Maybe here on this VIX chart I have here in front of myself, in front of me here. Yes, I can show you divergences. Look here, that's the nice one. Maybe that was what we talked about, where the question raised or came up, whether we can predict the down move here. Christoph, I watched this. Give me some seconds. Give me some seconds. Don't rely on indicators. Just watch and learn You don't need any indicators. I promise you, you don't need indicators. And divergence is here. Look here. That was, who was this?
Remo, I guess.
Divergences.
Remo, I guess.
Myron, can you show all divergences? I lost it. Myron asked, can you show all divergences on this chart? Yes. Look here. SPY dropped, or S&P dropped very hard here. Okay. Came back to the same price here. Okay. We don't see any significant changes in the VIX. And then it retested the low here of 466 again. But then, watch what happens. That's a divergence. It's not, the line is not perfect. Don't mind the line. The line is not perfect, but you see the divergence here. You see what happens in the VIX. It touched 2 times 1746, the second time 1746, and the third time it traded lower at 1737. That's a divergence, guys. And if you don't see that, if you don't want to go, or if you don't see that in the SPY, then wait until the VIX starts to drop. That's a divergence here. A very nice divergence. HYG is a little bit hard to read. As I said, it's extremely slow. But when the HYG rises, then you can say the ES on SPY, and others will rise too. Good. That's a divergence. Let's see if we can find another one. That was a divergence too on HYG. Yeah, that was not really not a spectacular one, but anyway, if you see that, you are trading from 47.25 to 466.38, maybe 5, 6, 7 points. I don't know, maybe even 10 points here. That was a divergence. Divergence in the VIX. It was that day was not so obvious, but you see it started to fall from the beginning on. It started to drop. The VIX, the VXX, and the UVXY started to drop. You see divergences here, and as well, that's a nice, another very nice divergence here. You see there the relief in the volatility here. The relief in the volatility here. Stay in draw mode, okay. That's a divergence, ladies and gentlemen, what I'm talking about here. That's a divergence, a very, very nice. So the ES, in this case, as well as the SPY, retested the bottom here, 64, whatever it is. You see that on my chart. But what happens in the volatility index, it starts to decline. It starts to decline. It goes down. My intention as well here, HYG is going up. My intention and what I would like to achieve with you and give you the material and the tools and the ideas on your hand is to understand then this market relies on the options market makers, on the big markets where the prices are really relevant and where they are hedging. When they are hedging, they are not hedging 500 contracts, they are not hedging 3,000 contracts, they are not hedging 10,000 contracts, they are hedging 500 millions. Yes, I'm following, as you know, some other guys, option guys like Cem Carson and Perfiliev and other ones, because this is an extremely important part of, or should become an extremely important part for our trading here. And Alexander Perfiliev wrote, for example, I quote him in of one of his, I think it was even on Twitter, I'm not sure, but anyway, there was a big trade under the surface, and that was a so-called options Siegel spread trade. So far I know, let me see, that Siegel option strategy was it. And just to mention one point what we are talking about, to give you the dimension of what we are should expect and what we see in the market. I quote Mr. Perfiliev is, for example, if that means to delta hedge, he's talking about delta hedging. For example, if SPX rises plus 1%, so if the price of the SPX rises plus 1%, the funds delta on this trade will move from minus 0.60 to minus 0.63. That means 0.03 points. And the dealers will need to sell that extra 0.03 points of SPX delta to remain delta neutral. In dollar terms, and that's important what I wanted to say. In dollar terms, it means they need to sell. Let me just text that here on the chart. Just in dollar terms, they need to sell. Give me a second to visualize that here. Given the price of the index is 434, the current spot price is 4,340 by multiplied by 45,000. That means just a moment. Okay, so that is the amount of money they must hedge when the index, the price of the index, which was at in this example 4,340, goes up for 1% move. They must sell 585 million, and you can imagine right now what dimensions we are talking here when we see the big hedge funds and big institutions, big banks trying to keep the exposure to zero. That's really big numbers. We can't do that in the ES, in the E-mini, in the electronic markets. It's not possible. Therefore, keep in mind that the gamma is the acceleration of delta. We have the implied volatility. This is simply what we can measure, what we can see actually. And we have, I'm added this high yield bond because it's quite interesting to watch it. These are really the world. This is the environment where we are in as traders, and we must keep that in mind when we are trading. We should not just focus ourselves, and I will talk a little bit about that, on a single indicator or on an iceberg, for example, on whatever you might have on your chart or whatever you have maybe learned. We should keep the big picture in our head and understand what the market is, what the influences in the markets are, to see the bigger picture. And when we see this what I'm just trying to demonstrate you or to show you here, let me clear that. No. We'll put this aside here. When you understand this big picture, then you won't look here, okay, that might be a stop run, that might be an iceberg, that might be a sweep, that might be whatever, because you see, okay, the market is really ready to lift off. That's the point here. The market is ready to lift off. It's the next discussion we must have today is what are the minors? How can we see where to enter the market? That's the point, to keep our risk-reward ratio or risk low, and the ratio to the highest point, or to the biggest gain we can get. It's quite it's not easy to manage that, but that's what we have to learn. Maybe there was a liquidity as well here in the ES. I don't know. Could be that we have a support at this level here in the ES, and then. That might be a good sign for us. Okay, we see the market, the VIX is dropping, the VXX is dropping, and as well the UV is dropping. Let me have a look. Just a moment. Clear mouse. Okay. That's the UV, and now I bet because I'm not sure what happens right now, but I bet the ES is trading higher here. We see a very fast down move, and we see the liquidity here as well. The same principle, it applies. The principle we discussed this week applies to every single market. There is no exception. Yes, the ES dropped down very fast, and then now it's trading up. We have a possible target at 1524 here. If the market trades 1524, if the UV trades into 1524 here, that means that the volatility index will rise and the ES will drop down. That's the next assumption, or that's a valid assumption we know, because liquidity is there. Liquidity is a magnet, or acts as a magnet. Let's see the ES right now. Yeah.
Walter, one question.
Yes, go ahead.
Go back to UVXY, please. Okay. This is more of my this amazement or whatever based upon our liquidity theory. The red line at 1525 is attracting UV, and that is inversely correlated with our SPs and other things,
yes,
based upon the wonderful teaching you just did, right?
Yes.
That's great. So, but how that liquidity is, because this liquidity is local to UV, but that it is linked to the SPY. So, what amazes me is how these two are so correlated so tightly, UVs and SPs. Just because of a liquidity here can create that much of impact. We're just talking of liquidity at a UV level, right?
Yeah. Every market, you can't. I think, at least I can't say that you can relate this liquidity directly to the ES, because volatility indexes are a separate trading, separate trading places.
Instruments. Yeah, they're different instruments.
Yeah, they're different.
There are people who just trade.
Totally. Yes, absolutely. And I would say those who are, at least for my point of view, who are trading VIX. You see how they are pushing the price up here. You see the absolute liquidity came up. It supports the price, and it's most likely that the UV is going up to trade into 1525, the next 1550. That's our first map. When we are looking at a map, our trading map, then we see, okay, we have to drive. Excuse me. Please mute yourself. That's a little bit too much noise here. So when we look at a map, let's see, that's a map. So we don't have Google Maps, and we don't have other help tools like 20 years ago. We have only the paper map. You open the map, and then say, okay, straight ahead, there's the building I want to go to, or I want to drive to, and that's here. We see this is the first target. We see. there's no, Srini, there's no guarantee whatsoever that this market is or will go trade into 1525 and 1526. In this case, it was. In this case, it was. It is a wonderful example how we can read a market this way today. It's easy. It's easy money what you can do today based on that knowledge. It doesn't matter what
exactly.
it doesn't. Excuse me. It doesn't matter whether you see thousands of icebergs here. It doesn't matter because you see what the volatility is doing and the volatility indexes. The VIX future is extremely slow. You can add it to your chart. I didn't add it to the chart here, but it doesn't matter. You rely on the VXX. Let me have a look here. Here, the VXX, the same picture or very similar picture. I recommend a UV, and then let's go back here.
Yeah, what I was trying to interrupt you is if you would have placed ES right next to that UV while you were speaking a minute ago, it's just straightforward. UV is just eating the top parts of liquidity, and here bottom ES is just moving down.
Yeah,
you can just see.
Yeah, I don't need at least I myself, and I'm sure if you are willing to following my advice, you wouldn't need any other indicators. It might sound ridiculous what I'm saying for you, because we are aligning or we are relying on indicators and charts and whatever. But if you watch simply this chart here, you don't need any indicators. You really won't need any indicators. That might be very I will provoke you in a few minutes about this, just to talk about how to learn this magic. But guys, it's nothing magical here, really. I just show you the connections between these markets, and you can rely on them. Just if you either you have Bookmap, then you should have the UV or VXX or VIX future. Doesn't matter what you want to have. I suggest to having them, to having the both. Oh yeah, I'm here in the. Just a second. I was a little bit confused here. So going back. So that's the picture you see. That's the picture you see at the beginning. VIX dropped. No, excuse me. Has risen very, very strong here. Dropped a little bit and is starting to rise again. Let me see what's in here, guys. Myron, try to find. Just give me a second. Find divergency, spine, VIX. Yeah, no, I will show you that. Seems to work in good market bias. Great stuff. Option flow. This is a perfect tool as well. Yes, no, it's Black Friday. Blah blah. Okay, just telling. Using for confidence, we can have a look at that. Okay. Argo, be in mind, volatility instruments are mostly hedging instruments, spot and through options. Yes, that's important. That's important. But that makes this instrument so important. I'm not saying, and that is quite important to understand. I'm not saying that we should wait and watch every single bar here. You look at that. This is a green bar. That means. Okay, the market the volatility must go up, and that means the S&P must go down. I'm not saying to watch every single market, but we should find anomalies in the market. We should find pattern in the market where we can rely on saying, okay, the market is prone to drop here. There's nothing that is to discuss because at the beginning the volatility was high. The volatility rises. Rose to from begin on from the start of the session, and then made a break, and then started to rise again. I mean, this is hindsight, and it is not possible. And I think Srini, you have been who said that there's nothing. The markets are not. They're not preceding each other. That means no of this market is preceding the other market, so that we can say when the SPY falls or when the QQQ falls, is trading trades lower, that we can say, okay, now the ES is somewhere in a state where we have enough time to enter the market. No, this is, everything is in sync in time. We can't say if this small bar is rising, then the ES will, or SPY will do then something different. We have to watch the pattern. We have to understand, to watch, observe, and then you will get it. You don't need any single indicator and any single cent to spend to understand this system. That's the beauty of the system, well, once you understand it. Yes, volatility, as I mentioned yesterday, therefore I talked very briefly about options to understand. We have gamma, which could be a part of your trading if you are following spot gamma. If you are using my or that what I'm receiving from the institution, the institutional levels, they are more precisely than the spot gamma levels, but they are static. We will talk about a little bit later, but they are static. They are showing maybe the price is going up and then the line becomes resistance or turns into support and vice versa. That's the one point. But what's really moving and shaking the markets, these are the volatility. This is the implied volatility where the big market makers are doing their job. That's the point why I'm stressing this here. Walter, do you use trend lines on ES or no? No, I don't know. I don't know. I mean, I have them in mind. I have them in mind. So I see the trend lines here, but I don't use them. I just, I'm a simple man. I'm a simple man. I just want to make some bucks. Then I'm closing my PC and enjoying my life. That's my goal. What is your Discord channel where you post the insert? This is on Discord, TTW Trader on Discord. I have a wonderful family. The life is so short, guy. The time is so fast. Look, we started on Monday. Now we have Wednesday, and I feel we started. I feel the time, at least on from my perception, is simply flying, and I don't want to be around here 8-10 hours in front of my screen and watching what the ES is doing. No, that's not the point. I just want to show you that there are really exciting and high profitable opportunities in the market when you understand how to connect these puzzle pieces together.
Hey Walter, would it be fair to say if you watch or monitor the correlation between ES and the VIX indexes, that if you are in a positive correlation, that you have to be aware that there could be a bottom or a top in?
Yeah, positive. What means positive? They are in
positive correlation, that they go in the same direction.
Okay, yeah, that's a warning sign. Absolute, yeah. To me, that's a warning sign. That what happens yesterday. We discussed that. That was I think it was this move here. Yes, that was a positive correlation, as I think if what you mentioned here. That is a positive.
So there is then also a way to spot divergences, I guess.
Yes, that's a positive correlation, and that's really unusual. And that was the top at 10, and the top was in the ES exactly at 47.10, where the institution level was, and then yes, it traded back. 1 point more. 1 point to yesterday's discussion on sweeps. Do you remember, guys? Do you remember that we have had? We talked about the sweeps, and we saw, I think, 2 or 3 sweeps where a player was selling, I think 2,000 or something like 2,000, 2,500 contracts actively. Not sure whether it was 2,000, but let's say 2,000 contracts. There was a player at, I believe it was 90, 46.90. No, I don't have any icebergs on chart because I'm I'm yes, Chris, I don't know how that matters now for this discussion, but you see all the icebergs in the dynamic plot, but I want just see 300. I'm just filtering 300. I don't want to see the big one. I don't want to. I'm not interested in 10, 20, and 50 icebergs here. But anyway, just aside. Okay, come back to that what we have discussed before. Do you remember that we have talked about sweeps yesterday? And let me go back. Let me go back on my chart. I have 5 days, 6 days of historical data here.
I believe, Walter, I believe it was 3,000 sweep.
Yeah.
And then it was 1,200 got consumed in one.
Yeah. I don't see them right here because I'm starting my bookmap every day from scratch. But I think that we saw sweeps around 90 here. There have been several sweeps here, right? Can you remember that? Tom, thank you. And that we discussed about the sweeps, what the sweeps are. This is a single order ID. We can find a single order ID. This is an algo-driven mechanism. He wants to catch 3,000 in a row. If he get the 3,000, if not, then he take what he get, and then he passively cover his remaining positions. Then that's really interesting to watch. But we are talking about 3,000. Let's say 3,000. There was a guy who was selling 3,000. And so far I know, I was not concentrated at the end of the session. As far I know, there haven't been any 3,000 icebergs covering. Oh yes, I'm not sure. I'm not any big icebergs covering at the end. Most of the time, if someone is selling, let me say 3,000, you will see a covering of 3,000, 1,000, 1,500, 500, 2,000 at the end of the day. I haven't seen them, but I must admit I haven't watched it actively. So maybe something is I'm missing something here. So not sure about that. Anyway, I think there haven't been any sign. So there was a guy who sold at 47.90. 3,000 contracts, and what happened? The market went up against him 20 points. 10? Yes, nearly 20 points against him. That's ridiculous, or that's something we never want to make here, never want to trade when a trade goes 20 points against us. So keep as well this in mind, that there might be really big players in the market, and they are not concerned about going the market against him for 10 or 20 points. Maybe he expected, and that's speculation, maybe he expected that the market will drop further. And if he is selling, maybe we'll sell some big icebergs, or see some big icebergs today here. Maybe we will see big icebergs today here. 3,000 or 2,000 or whatever, that might happen. And that might be a sign as well that when the big players are positioning themselves, watch which side they are selling into, which side they are selling into sweep, a sell sweep or a buy sweep. So that's just to accomplish the discussion of sweeps here, which we had yesterday.
One question though, do we have any kind of indication of the sweeps and icebergs that were there coverings, exits, or entering to the market?
Yes, we have indications in the Trade Finder here. It's an excellent instrument, guys. I will promote. In fact, that's the best instrument, the best add-on for Bookmap you can have. The sweeps, I'm sure you have been around yesterday, and the sweeps are excellently analyzed by the Trade Finder, and it shows you exactly what is traded and how much was covered by this algo. A sweep is as well in our philosophy of trading philosophy a stop run. I don't have a good example right now here, but we might see some examples along the day or maybe tomorrow.
Oh yeah, I remember that there was like
what I wanted to say, just I'm not sure, ladies and gentlemen, I'm not sure whether, dear colleagues, whether we have had a covering here at the end of the day yesterday. I'm not sure about that. That was the 7. No, that was here. It might be, but I don't know. So I'm not sure if there was a covering. So, but I don't believe that because we ended up in 96. The close was 97, I think. Yesterday's settlement was 96, 97, and he was short 90. So let's discuss it more theoretically and see if the market drops further down here, maybe into 70, 80, 70, 50. The institutional levels indicates a low of 60 or 60-ish area. If it's going down, then you can imagine he was selling 90, 2,000 contracts or 3,000 contracts, whatever, at 90, and then he might cover at 60 or something. And you can do the math what his earnings or gains are in this game here. Okay, guys, that was a great day yesterday based on that, and I see you a little bit more reluctant, and I see what I feel is that you need indicators. Give me a little bit more motivation for you. Just a moment. Yeah, this is a discussion as well. In your documentation, I have put 2 screenshots of. There's a very nice look here on the right side, on the right chart in your documentation. You see the divergence here. If the market goes down and touches the double, or yes, this price, that means this is a double bottom here. You have a wonderful entry signal. It doesn't matter whether this is an iceberg and sweep or whatever. Doesn't matter. Ignore it, because it's simply a buy. It's a buy. Nothing else but a buy. This is as well what I'm saying to everyone and to you is, with this knowledge you can improve your success rate and your probability greater or higher than 50%. You can be 60% right all the time when you understand, without any indicators, without spending tons of money, what the market is doing for the ES. I'm talking about the ES. I think the same I will apply to the NQ. In case you are Myron, you are trading NQ. You will see the same behavior. I have after the seminar, I will have a closer look into NQ as well, and maybe add it to this the documentation as well for you as an update to have an idea. Okay, guys, knowing that, now it comes the motivation. Yes, Frank, great. But what I just, please be focused and be concentrated for the next, let me say 10 minutes, okay? Because what I want to say now and what I just want to point you might be a little bit more strange. This is not a part of your documentation. I did an update tonight or this night because as always when I'm sleeping I've got the best ideas. And I added 2 slides to the documentation. I will update it, and you will get the download link for the newest update here. Guys, when you understand this concept, and this is really known rocket science, it won't cost you any cent. You will be a winner. You will be a winner. Ladies and gentlemen, every one of you, if you are following and allow yourself to dive a little bit more into this concept, you will be a winner. And I will give you a nice, interesting task for the next days or for the next weeks. I pointed out in my presentation, my video, and what I'm writing is that I personally don't like guessing. And I'm saying here very openly that guessing was yesterday and trading is now. That's not marketing stuff. That's not marketing bullshit. That's really what I strongly believe. Guessing, no trade, don't guess. I would like to motivate you, and by saying following. We all are, let me say, a kind of addicts. That means we are addicted to indicators, we are addicted to charts, we are addicted to systems, whatever, because we need that. We need lines, we need indicators, we need more lines and other charting programs, you name it. That's what we want, what we need, because our inner monkey, you remember the discussion of what I said on Monday with this wonderful book, The Chimp Paradoxon. Chimp Paradoxon, I would recommend as well. Buy it, read it, it's extremely well. It does not apply to trading. Trading is only a very, very tiny part of probably our life. But when we think about trading, then we have to come to a situation where we have to silence our inner monkey to say, okay, everything is good. This addiction where we are saying, okay, I need a line more, I need an indicator more, I need a chart more, I need a signal more, is simply the point that we need to silence our fear center in our brain. You remember the amygdala, when you read about that, this is our fear center, and our fear center protects every one of us, every individual on this planet, to protect to die from dying or from accident or whatever. That's really easy to understand. We have a protection system, a self-protection system. I would propose to you in this case, and I call it a chart and indicator detox week. You might laugh now or be astonished, and maybe something, a little bit weird to you. You know, it's a little bit. I don't know. But I would propose a chart and indicator detox week. Or rehab week. I like more the word detox. That is hard, Walter. Yes, it is. And but let me just tell what I mean by that. As we have discussed this week, for example, Reimer and I, this is a stop run, and I'm saying, I'm very, very cautious with stop run. Zoom in and see if this really a stop run. We simply addicted to any kind of signals. That's a huge multi-billion industry out there with chartings, with signals, with whatever add-on systems, whatever you want. This is a huge industry. Everyone wants to tell you he has the best instrument. And by chart and indicator detox week, I mean that you should reserve 1 week, 5 days, only 5 days, ladies and gentlemen, 5 days. That's not much. 5 days. You see how fast, it gives you the best. I'm just got distracted here. So this is written to you alone, but okay. Okay, good. I would like to motivate you to do this chart and indicator detox week. 1 week, 5 days. Subscribe to the CBO DX or CBO data to receive VIX, VXX, and so on. And put only 2 charts. Such a chart, this chart, and excuse me, or similar chart, if you have Sierra, whatever. Sierra, whatever, and a bookmap chart. And maybe an add-on like TradeFinder or whatever you want to have here. And watch only those two charts using using the UV, using the VXX, the VIX, and so on. That's all what I would like to propose or suggest to every one of you. Oh, excuse me, so going back. One bookmap chart with bookmap and one chart with SPY, VIX, VXX, and UV and HYG. Leave all your other charts closed, all signals closed. Don't look at any other signals for 5 weeks. And see what does this suggestions make with you. Then when you got this week, this detox week, I call it detox week, come back and use whatever you want. But try and see to understand the big picture, to see the big picture. Fine tune your entries with Bookmap and TradeFinder, and you will, we will talk about in a few minutes about optimizing the risk-reward ratio. And what I wanted to discuss, maybe it's always important point, that we are spending a lot of money for charting programs, for indicators, for whatever services, and it's as well important to understand if we need everything of this expenditures for every signal indicator or whatever. That's really important. I have had a discussion with several traders here. They're spending 500, 600 dollars for Bookmap, and that's really, they are not successful with Bookmap, of course, and so on and so on. So save in money, and yes, you lower your trading expenditures, because you don't need really many or much indicators for to be successful in trading. And what my goal is here, achieve happiness in trading. That's if you are not if you are not happy what you are doing in trading, then something is wrong. Rethink that. That's my advice. And be successful. Allow yourself to do this detox week, 5 days, and then see what is the result at the end of the week. If either you can work with this approach, with this charts, or you can't. That's there, or you can find a mix between this approach and your personal approach, with maybe you have market profile, volume profile, footprint, or whatever. It's really not hard. Just observe, sit back and observe. And either you will see what happens, and then you can transform this knowledge into your trading into your trading experience, or maybe this is really something really strange, and that's something you should then retreat and find your own way. Any suggestions or ideas? Should we do, ladies and gentlemen, a test? Let's do. There is no, Levi, there is no indicator for detox. What I'm saying, Levi, is following. Close all your charts. Watch the SPY, the VIX, VXX, UVXY, and the suggested high yield bond, and put your ES chart on a second screen and simply watch those both screens or charts. Nothing else, really nothing else. No single indicator, nor not an divergence indicator, not an RSI, not a moving average, nothing. Simply a clean chart. Levi. There's no indicator. We don't, guys. I provoke you. I know. And I'm doing it consciously. normally we don't need indicators. We have liquidity for stocks. That's a good break. That's the most important one, and then we have this wonderful correlated markets, which costs us nothing. Costs us nothing because either we have them, or maybe we should subscribe to CBOE. You can do that by Kinetic is providing the data. I'm sure IQ Feed as well. Every other provider does provide CBO data, DX Suite as well. That's all what we need. And then go back, sit back, watch what happens. That's my suggestion for the detox week. I would like to do a test with you, maybe just for fun and just to keep you awake. Yes, Julas, yes, of course, you are right. Sorry for that. The detox week, you can add as well. Yes. Good point, Julas. You can add. I just have the SPX here on this chart. And I'm watching the tick and TRIN and ADD. Yes, you're right. So when you see ADD coming down, minus 800, minus 1300, that's the broader market advances and decliners, NYSE advances and decliners. You have them as well for the NQ. Then they will get you another idea. But you see on my chart, I don't have any indicators here. I don't need them. I have the reading. Okay, the market is more to the downside. The ticks are negative. The SPX is down, the VIX is rising, coming to a retrace here and maybe rising again here. We will see that. But that's all what we need. If you want to have ADD and tick and TRIN, yes, they are absolutely helpful. It can complete, yes, it will complete the picture when you understand what's behind ADD and tick and TRIN and so on. Of course, yes, Julas, good point. Thank you. Okay, let's do a test. Maybe some of you know this test. I am aware what I'm just going to show you. It's an attention test written by. Sorry.
So it's you probably ask us a question after that.
Yeah. I just let me show you what I want to do with you here is following. Sit back, relax. Sit back and relax. You will see players here in this very short video. It's only about 30 seconds. And so late task is to count how many times the players were wearing white pass the ball. So you will see white and red players, and you should simply sit back and counting the white players with the white t-shirt. They are passing the ball, and count how many times the players wearing white means white t-shirts or shirts, pass the ball. Okay? Okay? Let's see. So are you ready? Lean back, relax, and go ahead. So just to this 3 ladies here in white, and there are 3 ladies in black. They will simply play the ball and pass the ball to each other here, the white to the white and black to the black. Please focus yourself and count how many times they pass the ball. The ladies with the white t-shirt pass the ball. That's your only task for this very short and brief test here. Okay, let's go. Okay, this was a test. The question is, how many times, you can type it in the chat, how many times did the white ladies with the white t-shirt passes the ball? Great. Some more? Come on, guys, don't sleep.
15 times.
Good, good. No, I can't replay. You can, by the way, it's, Julius, you can't, that's okay, that's okay. But the main question remains, there's one main question which remains here, is, did you notice the gorilla? Good, 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 good. I mean, that this is a very old test, but it's always interesting. Great. So what this test is about is to show us that we can focus on 1,000 things or other things, especially in trading, seeing the smallest signals, but we don't see the whole picture. That's the selective attention test by Simmons and Chabris. Which is really worthwhile to see. It's funny because yes, we want to see the gorilla. We want to see the gorilla, and this is the big players, and not the smallest signals, not the smallest whatever we have here on our chart. That might be of interest, but it's not our task to see every small signal or follow maybe a crosses of MA, moving averages, or what indicators we have. We want to make money. That's our goal. And what I'm presenting you is simply a system where you can focus yourself on the market without any without complicated and whatever signals you might have, indicators or whatever add-ons you might have. It is simply a really great signal. We have to discuss in the next 1.5 hours about the finer entries, the fine-tuned entries, and how that might work in the market. And then we will have a really good and complete picture about the whole market. Okay, great. Any questions so far? Okay, great. Coming to the strategy section. I hope everyone is on board here. And you can hear me as well. So hopefully, can you type on Y? Can you hear me? Just give me a signal to check that everything is okay. Okay, thank you very much. That's fine. I just want to proceed and finish this day with a strategy section where I think we should have a look first at the macro view. That means we should understand where the market is trading, what the market is doing. So the first one we should see on our chart is watching the liquidity. That's the first view we should have. But I think, I'm not sure who it was. I think it was Reimer who mentioned that we can fall in love with liquidity, and that means the liquidity on the chart. When we start, we see liquidity at 47.12, 47.07, 47.05, really long-term high liquidity resting in the book here. And we maybe are, or yes, how to say, we may be seduced to say, okay, the price is going or will go straight up there into 5 or 7 and 12, and then we might say, okay, if the price goes to 12 or whatever it is, what price it is, then we have to go long. That's by no means. When you're watching the market every day, then you will see that the long-term high liquidity may rest in the book for days and weeks, and that's normal. That we saw that at 46, I think it was 46.50, where the long-term high liquidity was resting in the book for weeks, and the market traded against 46.50 or 20 or whatever, dropped down and came back and then dropped down again, traded lower, and then finally after 2 weeks they hit 46.50. So that's not a conclusion where we should say, okay, this is really something we can't rely when we see liquidity, but it gives us a great idea what a market might do. Today we have had, I'm not sure anymore. Oh yeah, 47.13, 47.12. Yes, that's what I'm watching. Was watching at 47.12, 47.13. There was a big liquidity there. They added at 06, 07, and you see what happens. This guy was sitting at 47.12, and you see by the color or with the color here, the color was or is, what is this, red, orange here at 12, and then he is canceling the liquidity around 12 here. That's a very nice and beautiful sign that this guy who wants to trade at 12 or 13 here at this level didn't await the price to coming back. Oh yeah, he is adding here again. Oh, he starts to add. That's interesting. Watch here. As we saw on the volatility indexes, the price dropped very hard at the beginning. So if you are short for 46.90, you got or have been short blindly based on the volatility indexes, then you got what's the theoretical outcome? 10 points, maybe 10 points here out of the first move. Then we saw a high volume traded here into 46.81 at 15.51 my time, indicated as well as a kind of it's not a stop run, it's simply a high volume traded here in the 51. It's, as mentioned, this indicator is very similar to the SI, or the stop tracker of SI tracker here, of Bookmap's SI tracker. It's very similar, so you see that here. Very high volume traded, then it dropped down, again retested this area, and then building a divergence as well here. We talked about divergence. You can read divergence based on the Market Volume Pro. That was the traded volume between, you can measure that as well, minus 793 into 2,440. That means 1,800 contracts has been traded here at what is 10:51 Eastern time. 10:51 Eastern time. You can measure the volume by hovering the mouse on MVP. In this case, you will read minus 770, and the tip and the bottom of this of the MVP of the Market Volume Pro is at 2,440. Let's zoom in a little bit to see it really hard exactly what happens. High volume simply was traded here. Let me see if I can catch that better. Minus 800, and the low was at 2,400. That means between here and here, in that time, there have been traded 1,700 contracts. That was simply a sell-off into this area. And when you see this big sell-offs, I'm not sure why the Market Explorer didn't show up here. Maybe the time, I have very straightened the time here. So when you see this volume trading here, very high volume, exhaustion as well here based on the price dynamics, then yes, that's here. The volume spike. You see exactly what was traded here at that point. Nice signal to be alerted that this might be really something you should tighten your stops, maybe taking your profits off the table. And a very nice signal came up here. 966 traded again. That was a really nice, but a smaller volume spike here as well. So you have very nice signals based on TradeFinder, which are showing you the swing highs and the swing lows. And we are looking for the swing highs and the swing lows, as well as the divergence that was extremely nice and well. So what we are looking at is liquidity as the major point anchor, the major anchor for us to understand what the market might play today. There's no rule and there's no guarantee or whatever. There's no rule or no guarantee whatever that the liquidity will hold, that will resist or will stay there. It can be cancelled, as you know. Liquidity can be cancelled, as you know, very, very easily, and or fast as well, and they can resist. So our first view is to understand, and by that I'm meaning not on the future. Let's have a look at the UV. We talked about that. When we started, we saw the big liquidity here, then they have been added here, then they added liquidity at 1501. That was the next liquidity level, which was added at 1490 roughly, and they're adding liquidity right now at 1490. So, but that's now during the market. Let's have a look at Apple. I have Apple somewhere here. Yeah. You see how fantastic TradeFinder works here. That's what we want to find. We want to find this huge swing highs and swing lows. And when you're trading Apple or when you're trading stocks, the same principle applies. Absolutely same principle applies. You see, you start to, you open your chart, you get a first impression of the instrument, which is we have an extreme high, or we have high long-term high liquidity at 153 with 290,000 contracts, 290,773 contracts. Look here at that one. And that is the attractor for the price. The first level we have at 152. The second was at 152.20. And the next one was 152.50, and the next is 153. So this is important as well. You might trade stocks with options. And if you want to trade them as well, you want to know where the market is most likely to go to. Well, what is the direction? What is the direction of the market? Where will the market trade? So you will need to buy a call with a decent premium, and then maybe taking your profits here on the way up from 151.60 into 152.50 whatever it happens. Then you see really nice icebergs hitting at the top and as well here. Let's see Tesla to prove our theory as well. Yeah, come on. The imbalance line. Tesla as well, the same picture. I'm absolutely sure you understand. You are totally understand. You totally understand what I wanted to say, what I wanted to suggest, and what I wanted to say here is it's the same principle. The big picture is based on liquidity. The big picture is based on volatility and the options. That's the big picture we have to have. So you see liquidity there. You find nice volume spikes. We talked about volume spikes, which are kind of exhaustion. You have to go against them. You have to go against them. Let's see QQQ if you find something. I will ask Ed. I will answer your question. That imbalance line. I'm not sure what you mean by the imbalance line. Maybe of TradeFinder, I think. Yeah, that's if you see the QQQ, you see liquidity as well. It's much harder to follow the liquidity on the QQQ. You see all this small fractions of liquidity up and down. That makes it really hard. To follow and to understand. But you see as well big liquidity, and the next liquidity level is 400. If the theory is right and they are trading now here, and that might be, you see the volume spike as well. Some would say that's a stop run here into QQQ at 398. And because this was a long-term high liquidity sitting on at 400 and as well 401 as well, that might mean that QQQ will trade into 399, 400 and 400. Oh, it was cancelled right now, 401. You see, it's a little bit more harder to read that. It's a little bit more harder to read it here, but the trend is, at the moment, the trend is up. They added 20,000 at 398. It's more harder to read it here on QQQ. Let's see, what do we have?
Walter, just wondering, the imbalance line, I mean, it's on the bottom right of the chart. Yeah, I don't know if it's market volume pro.
Yeah, that's this line. So what we added is, by this line, it means the imbalance, the book imbalance. We talked about very briefly in this seminar. The order book imbalance is on the ask side. I don't know why I don't see at the moment. Yeah, it's much harder because you see this red channel here around the price. It came up again today. It makes it really hard for the imbalance tracker, based on the settings you are doing or you are setting in on your chart. What I want to see is the trade finder should watch for imbalance from the BBO, that means the first price level, to the 1880 ticks, that means 20 points in ES. That means this is the range from here. Yeah, I don't know. Yeah, from here, 20 points up and 20 points down. And then I expect a signal on chart which shows me, okay, the imbalance is on the upside or imbalance is to the downside. We go to the documentation. I have put some links, some sources which describes the phenomenon of order book imbalance very good. And if you are interested in imbalances, by the way, the most other charts like Ninja and Sierra has their own imbalance counters. You will see that where the imbalance is, given the imbalance to the upside is higher than the imbalance to the downside, which is now indicated here by the imbalance line here. That means the imbalance, the liquidity on the upside is higher than the liquidity on the downside. This is the meaning of the imbalance line here. The market should go towards or to the imbalance in the book. That's the theory, and that's what is behind the imbalances, order book imbalances. I think I have put some links in the documentation about the order book imbalances. It's not the strongest point, the strongest signal, but it keeps us aware that on the upside we have more liquidity than on the downside. So the price might now trade into 92, and at the moment we don't know whether this is maybe will be repellent or will be resistance in this case, or maybe the market is so strong to break through this 92. But the fact is the imbalance on the upside is higher than the imbalance on the downside. That's indicated by this imbalance line. On the other side, you should get I don't know whether I can reproduce that because it's extremely hard. Let me see if I can do that here.
So this is separate from buyers imbalance and sellers imbalance, correct? Or
resting, yes, it is. It is always calculated on the resting, on the liquidity on the resting side of the book, on the ask, on the sellers in this case, yes, and on the buyers in this case, yes. Now you see it comes up here. That's, you see this. What is this? Red triangles showing to the downside in this case, because I'm simply only saying to the program, watch for the first 20 levels, 20 ticks in this case. 20 ticks means 5 points in ES, 5 points in ES. So TradeFinder is now watching 5 points from the best bid offer where is the higher imbalance. And according to theory, imbalance theory of an order book, price seeks liquidity and price tends to trade against the imbalance. That's the theory, and that's why we invented or added the imbalance tracker to Bookmap or to the Trade Finder, just to give you an idea where the imbalance in the book is at that point, and it might mean that is an additional signal that the price is going in trading against liquidity. I'm using only native icebergs in ES. Chris, I'm using only native icebergs in ES. No, MBO, we don't have MBO data for stocks. No, we don't have MBO data for stocks. We use, let me say Apple. Where is the Apple here? We are using synthetic orders. They are calculated mathematically based on certain analysis to indicate the synthetic icebergs. There are no native icebergs in any stocks, in any ETF or whatever. Here there is a dynamic hidden order plot, and it indicates synthetic orders. Disobey or disregard the price dynamics plot for stocks. In this release, we have to do more research on how to define the price dynamics plot for stocks. That's really a big challenge. Not sure if we can remain in that. How about stocks? How about how to determine size for stock, right? Yeah, it's based on by doing, Chris, simply by doing. So if you have a high traded stock, look here, we have an average volume in Apple market volume, that means aggressive volume of 30,000 at the moment, 30,000 of a period of 20 seconds. And we have an average liquidity on the first 50 ticks about 22,000. So that means the hidden orders or the synthetic orders, icebergs, must be somewhere 10,000, 15,000, 20,000. There is no fixed rule, and we can't provide for every single instrument. It doesn't matter whether it's ETF, it's a future, it's a stock, a good number, because it changes constantly every day. If you are not satisfied with 15,000, changes to 20,000, and get an approximation what you want to see, what's of interest. You want to see the big one. You want to see the big whales in the game. That's what we want to find. We want to understand where's the liquidity. This is adding liquidity and acts as a support. We want to see the big icebergs. And when we have them, when we identify them, I don't know what the best number is now for Apple. I think it's for 15,000. Sorry. I have to activate it again. Then only the biggest one with 20,000 will be identified here on chart, and that might give you an idea and clue what the best settings is. There's no rule, there's no whatever. You look here, this is a synthetic iceberg which was traded into 152.30, and its size is 35,000. So no, I'm not using. I'm watching Fangmans, of course. I will talk to that in a moment, but I'm not using them. That's too complicated. I just want to. I'm a simple man. I just want to make money, and I just want to know where the market is heading. And when I see such nice sweet spots like in ES, for example, here, I know the market is straight down from the opening because of the discussed volatility indexes. It goes down. I'm simply joining the bid here, or I'm joining the market, whatever, or the bid, and I'm selling, or I'm joining the ask. It depends on what you want to what you want to do, but you can't concentrate on every simple how to say stocks and FANGmans. I'm watching them, of course. I have them on the NinjaTrader as well, seeing what Facebook, Google and so on are doing, Apple, Microsoft. But overall, are they leading or not leading? That's a question, but not whether how many icebergs. The only exception is that if you are trading stocks, you should have this tools on the chart to understand better where might be the high swings, and we want to see high volume traded where exhaustion happens, where a break happens, or we want to see high big icebergs in the swings. Like here, wonderful signals here, which indicates high volume traded, 2059 traded down here, as well indicated in the MVP, Market Volume Pro. And again, the next one, which was a perfect entry signal. And then you see, let me see what time it is here. 1600, that means 4, that means 10. Let's have a look here. Oh, that's great, guys, come on. Just to wake you up based on our discussion. Do we need these signals? Yes, I would like to see the signals, but this is not the reason why the market is going. This is not the reason, guys. This is not the reason. Either you are using SI or whatever you are using. This is not the reason to go long here. This is not the reason, not whatever. Don't tell you anyone that this is the reason to go long. The reason to go long is here. So, and then when you see that, this is a divergence in the VIX. The VXX is not following as well. The UV is not following right now here, but the H808, it's hard to read. So I don't want to refer to the HYG, but you see what the VIX is doing here as well. 14. Let me see here in 5 minutes. 5 minutes.
Walter, what are the clues that the VIX won't continue rising? Like, what do you use?
I don't know. I can't say that at the moment. Let us see the UV. So the VIX is down here. It's building a nice divergence. You see that was 1600 my time here. That was the high volume traded, doing a double bottom here, doing a second double bottom here in the SPY. And let's see this is the same picture here on the S. We have 1600, and let's see where's the UV? Just a moment. I'm looking for the UV here. 1600. Where's the 1600? So that's the peak up here. So very hard to say why they are doing that. Why that happened, because the VIX is showing a divergence here, so it's dropping down and coming back. I don't know. I can't explain that why that happened. Maybe no, I don't know. I can't say that at this point. But what I'm noticing simply is this pattern. I see the price comes down. That was the high volume traded here. The signal was at 1600 my time, and then at that point the VIX was down. So if you're not sure, then wait and maybe join the move a little bit later if you're trading and not sure either to enter here or maybe a little bit later. But that's quite interesting here. Maybe I see this as well as the first time, that this is a peak up and then it breaks down. That's a very nice, that is a very clear divergence I see on the VIX, but not on the VXX and UVXY. So let's see in the VXX here. 1600. Yeah, it's the same pattern. It's absolutely the same pattern here. That was while the VIX was falling here. those the UV and the VXX are making a spike up and then breaking down. So Julius, I can't explain that at the moment. I don't have any explanation. I don't know if we need an explanation for that, because I saw simply that and saw this double bottom here in the SPY, and ES was making a very nice volume spike here. And on the other side, when you're watching that, you see a very nice divergence between this traded high volume 2000 versus 469 and this volume here 966 in one versus 199. That's a very nice first divergence. We have a nice signal here, and we have additionally where is it? We have an additionally divergence in the VIX here. Although you are right, it's not a perfect signal. You're right, it's not a perfect signal. Good. Let's go ahead. The macro view, we want always to know where liquidity is in the book for stocks, for ETFs, for especially, I think from my point of view and what I'm talking to other traders, friends, is that it's sometimes much easier to trade stocks than futures, because you have a very clear picture of liquidity. Yes, you have the UV, you have the ES, and you have here the VXX, just to give you an idea what's possible when you see liquidity there, and you see liquidity then mostly on of the time in the ES on the lower side. We see then liquidity on the upper side on the UV and as well and the VXX. That gives us really a wonderful picture, a wonderful first impression what the market might do. So the question of I think it was Chris, was do I watch FANGs? Yes, I'm watching them. They are part of my market overview. As you know, liquidity acts as a magnet. Liquidity is providing or taking energy. That means absorption, book flipping, and support and resistances we will see along the day. We see order book imbalances, as just mentioned, based on the question from, I think it was Ed. Order book imbalances are really good described if you follow the links I've put in this documentation to learn more about order book imbalances. And as I showed, and he has an order book imbalance chart. And as well, I'm sure any other Thinkorswim or Sierra, it's really common today. That's nothing really special. And we should use liquidity as our guidance orientation throughout the day. That's the main goal of when we try to get a picture. And that's what Ed asked is, yes, we must watch the FANGs, the broader market. The Microsoft, the FANGs making 45% of the Nasdaq, 3.8% or 4% of S&P, and 28 or not 29% of Dow Jones. We can't miss them. I have one indication which shows, or if you are using NinjaTrader, you have you can add the FANGs to a chart and see them. Let me show if I can. Can you see my screen right now here? Do you see my market watch? Can you see my market watch? No? Okay, I'm back. It doesn't work here. Hello, I'm back. Can you see my screen, please? Can you see my foil, my chart? My presentation? Okay, I'm not sure if this works, but I have a market watch on NinjaTrader, and as well you have your own market constellations, and you should have a look whether if the FANGs are leading or not. That was the question of Ed, I think it was. So yes, I'm watching them, and as well I'm using the ADD. That was the question before by Euler and Tick as well. So that's the overall market. That's you need to know the condition of the market, what the condition, in what condition the market is, and then you can decide to go on further. You see the downside is leading, so and that makes you puts you in the position to say, okay, where should I take my trades? So the first point is get an overview. You do the detox week. I really would like to motivate you to get a really excellent picture about your market without having any indicators. I know we fear being without any guidance because we need a kind of insurance. But every indicator we have on the chart is a lagging indicator. That's the problem we have. And every indicator on the chart we have, and when we come together, we will discuss, and every one of us will have a different opinion what the indicator is doing and what might be the outcome now of the next one, and what happens with the price. It's going up or it's going down, or with the market it's going up or it's going down. There's a lot of interpretation in all these indicators. When we try to understand the dependencies in the market, the correlations in the market, then it will guide you far, far, far better. Because you see, I'm resisting to have any indicators here. We could have the RSI, because like in this attention test we did, where the big gorilla came in and we are focused on counting the ball or the passes of the ball passes in between this group, it distracts you. So we are watching the RSI and saying, okay, it's building a divergence here, but you see the divergence with your own eyes. You don't need anything else here, really, because we are not trained. We are not used to. We are not trained, and we are not used to be without indicators, because it causes a really weird feeling in ourselves. So we just don't see anything. We don't have any insurance. We need that and that and that signal. We are not using it. But when you are trying to detox yourself based on the indicators, then you will start to learn to be more, to see the market more as it really is. And there are really good helpers. We have this for the futures. We have this system for the Nasdaq. We can use it for the Russell, although we'll be very cautious. The Nasdaq can lead sometimes based on the FANGs, because they are making 45% of the Nasdaq, and that's really something we should keep in mind. Get rid of the indicator. No. Reduce the usage of your drug. So that's what I wanted to say. Reduce the usage of the drugs and see what really happens in the market. It will lead you far, far better than any drugs you are using. Okay? Yeah, cold turkey is not bad. Excuse me, I'm provoking a little bit. I just want to shake and to wake you up, to show you, yes, every one of us, not only we here in the group, but any other traders here around all over the world are coming from this, or having made the same experiences. Made the same experiences as we, because we want to be rich, we want to be famous, we want to be handsome, and that's our goal. But there are only, so far I read, only 5% which are constantly making money in this business. It's about confidence, yes. It is about confidence. We need a kind of insurance every single time. Okay, now when we understand that we can work even with without indicators. I'm saying that very cautiously. To understand the market, we have liquidity, we have the dependencies, the correlations of the named markets, how they work. We can now trying to find the best entry. To reduce the reduce the risk we have, and enhance the reward. That's the point. That's another challenge, and that's really a hard challenge for every one of us. I'm calling this stuff to find a nice spot, the sweet spot. I'm calling that a sweet spot because a sweet spot means you are in the game before the market lifts off or trade in a direction, to be in the saddle, to be in the market when the market starts to trend. That's the idea behind. So you see a very nice example here in the book map. This is a sweet spot here, wonderful, indicated by TradeFinder, as well as the Market Volume Pro. It's a perfect coexistence between Market Volume Pro, which is the stop indicator of the SI indicator, indeed this one, and the TradeFinder. It's wonderful. You don't. That is, by the way, who does not have the Market Volume Pro. It's a one-time fee. You don't need to subscribe. It's available on Bookmap marketplace here. So that's a perfect entry. That would be a sweet spot. Why? Because first of all, there are three reasons why that could be one or was one. In this case, it's hindsight, but anyway. We saw a divergence or starting divergence here in the VIX. We didn't see that in the VXX and UV. It was high volume traded here, and again tried high volume traded here at 1600 my time, and this is building a nice divergence. So the entry should be maybe around 80 with a nice, with a decent stop at 78, maybe 2 points here. The return is 80 into 87, or if you're trailing and waiting, then you get 10 points out of this move here.
Can you show volume spike signal, target volume, and the maximum on the book map?
Yes, Levi, you have. I'm not sure if I understood your question, but you should have the same signals as I have. If not, then please, Levi, go to the Market Explorer and change the maximum duration. I don't know, I put it to 5 seconds. Let me see if 2 seconds works as well. You know, the volume spike takes time to transact. Yeah, the other one was took a little bit longer. Please change the settings in your TradeFinder settings, Levi, and you will get the same signal.
Yes, I do.
Yeah.
Yes, I see settings.
603 seconds. So to transact, you know, every transaction takes time. So to transact 2000 or to trade 2000 contracts. Come on. To transact 1818 contracts here, 2000 contracts. It takes a certain time. And this is simply the time from 51 into 20, let me see it, 51.19 and 51.21. So 10 seconds, yes. It takes simply time to transact all this amount of number of contracts here until we get to the spike here. And this you can control by time. You can even rise this to 5 seconds and rise the number to 800. So you will see all transactions which are higher than or has a greater number of, come on, missed this one, 800 contracts, 5 seconds, should be displayed on your chart. We want to see the higher the better, because high volume means always exhaustion, and that means possible reversal points. As well, you see the exhaustion here very nicely on the price dynamics here. And I don't know here, not sure. No, there's nothing. So that's what I'm talking about, what I mean by saying that these are sweet spots. We want to see sweet spots along the day. If we are sure, then we are just joining the ask or joining the market here by selling. We have had an absorption at 6 here at the top. That might be a signal as well, directly at the VWAP. But it's really hard to say if we are so fast to join the market. Price dynamics is showing more sellers. They are hitting the bids, 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 hitting the bids. Then the pullback comes back, and then they started to sell again, and that's the sweet spot we are just waiting. The hardest point is, I'm not sure if Ray is around. No, Ray is not today around. I just wanted to ask him, because he pointed a few days ago that the hardest point for traders is to wait and to be patient.
Can we do some live trading tomorrow? Because that's really what I want to see more than anything.
Yeah, we do live trading.
When to get in, where to put your stops, how to trade.
Yes, we will do so. We are a little bit off here because this theory is really more than expected, and we took more time for discussion here. And we will trade tomorrow starting at 3 o'clock, make with a prep, and then see what we can do tomorrow and in the market live, hopefully. We talked about the sweeps. The sweep is always a single order ID, which shows you that there's something algo driven in the market. I don't want to repeat that. So we have determined the sweeps as a 50% probability to counter a sweep. There's a 50% statistical probability to counter a sweep. It's not much, and therefore I just give you an idea, what happens here. I just give you an idea how to trade it. You have two chances to trade sweeps. Sweep is a very fast, uncontrollable move. It ends like you saw yesterday at 90. We saw these big sweeps and talked about them. And it's not possible for any one of us here to trade them discretionary. That means when the sweep happens, we are simply surprised, and we are kind of paralyzed maybe as well, so that we can't catch the sweep at the bottom or top when the sweep happens. That's not possible. That's impossible, at least for myself. I'm not so fast to get in when the sweep happens. But what we can do is we can draw breakout lines. We call them B lines, and our idea is to bring them as well in the trade finder. That means when the sweep starts here, we can measure where the sweep starts, and whether we can measure where the sweep ends, and how many points or ticks the sweep is triggering or trading. When we know that, we could draw a B line and breakout line around the sweep and extend this line. It's totally bothersome to do this in Bookmap, because these drawing tools in Bookmap are, let me say, not the best. And therefore I think, like we added the price alerts in the trade finder, this is really something we should we will realize in the trade finder to give an idea that the sweep started here and the sweep ended here. And then the question is the 50-50% statistical percentage of success is to see where the breakout is of the sweep, and then follow the breakout of the sweep. So that's the one idea we have how to counter or how to trade sweeps when they happen.
Walter, question. Sweep, our original strategy, our original thing was to go counter it, right? So once assuming this B lines comes in, what is the strategy?
The strategy
is it a
Yes, the original idea was to counter the sweeps. Yes, it is. It still is, and the probability to counter a sweep will be 50%. So we don't have a higher statistical probability. We tested that. We can as well, when the sweep happens, we realize that the sweep is there. We can counter them by going long here or here, where you get a fill. It's really hard to get a fill, but anyway, let's theoretically speak. You got a fill here, and then it goes your direction, so for a few ticks. That's always the most critical part. They must break or at least trade to the upper B lines here, to where my cursor is, and then the chances are big that they're breaking out and going higher. This is one strategy. The second strategy is the B line, to see what is now to reduce the probability for negative trades. To reduce the probability for negative trades, we will add, or we are thinking about adding the B lines, the breakout lines, to let the sweep develop here. Let the sweep work. I mean, what it's on my chart. It's this one big guy who is selling 1,500 contracts. That's nothing unusual. So it's selling, and the market drops far down. So normally we would go against it, but we will make an even break. We will be stopped out here at break even, or that will be a loser here. A loser here in this case. So the other idea is, because sweeps are quite important and important market signals, we can use the B lines, and if the market breaks above this B line, that could be a good chance that the price will continue to the upside, maybe in the next liquidity level or whatever there is. That's the idea behind the B lines. But when we introduce them, I will make a video on YouTube to provide more information about the B lines and the sweeps. It's only one idea and one possibility how to trade sweeps. It's statistically not bad. It's statistically not bad, but it's statistically as well not the holy grail, trading them and going against them.
Great. One additional thing, since you guys do the lot of back testing, can you also look into the statistical probability of breaking the B lines?
Yeah, we are doing that. We are doing that. Yes, we are doing. I don't have any results so far. If we get something, we will. I will publish that and. Maybe on YouTube or wherever, or maybe for the seminar participants only, maybe for you as well, because I do not intend to make more seminars, but I will keep the documentation updated. We are doing that. We spend a lot of time to analyze the DIDs, the dynamic iceberg developments. That's really something where we put a lot of effort in. We are looking, by the way, we are just writing own algos just to test all this stuff, what we are doing, what we are cooking, we are eating by ourselves. So, and we are doing that. Yes, Srini, we are doing that. Be sure. As long as when we have the results, then something we can talk about. I will publish that on either on YouTube or maybe also here only for the seminar members to give an update on the documentation to say, okay, we tested that like you will see in the DIT for the DITs, and that's the outcome. You have to trade them that way, because we want to have some evidence of all these signals, not only saying, okay, that's, look here, the volume spikes. We discussed the volume spikes, and when we discussed the volume spike, we said that the volume spikes are high traded volume into a price, and then because of the high traded volume, the mass of volume, the price stopped and reversed. Or stopping and reversing and then coming back. Some, I know this contradictive discussion. Some are saying this is a stop run. This is from my point of view, I'm by no means a stop run. That's simply a traded volume from here to here. A stop run is something else where we see a very strong sweep and then the price bounces back immediately. That's a stop run. But here the price traded down, came to a rest, and then trading back, taking some profits here, coming back, and then we have the same stop run here, or volume spike. It takes time, you see. The only disadvantage of Bookmap is make us think that if we see that from this perspective, then that looks like a very maybe stop run, whatever it is. When you zoom in, then you see a complete different picture. That's really, and this is one of the big advantages of TradeFinder. We don't want, when we point to this bullet here, then the market stops there. When we see a sweep, we don't have anything like a sweep today, or an iceberg. Do yourself in favor when you have an iceberg on your chart on Bookmap, then you will see that this number you have on the Bookmap is different than I have here. But that's simply because you are zooming out of the chart, and then this number changes. So it changes from 200 to 300, 400 or whatever. And when you drill in or zoom in, then you will see maybe the right number 397. This is simply because we are not using the aggregation system, but and when we point to this 397 and 87 for 4687, that's the real number which is traded. It does not change. It does not change. It doesn't matter what you are doing with your chart here. These are fixed numbers. So these are the differences between other add-ons. We just want to see if the iceberg happens at 87, then it was at 87. It does not change. Keep that in mind when you are just working with other tools, that this aggregation might mislead you more than not, and saying, okay, that's the kind of signal here, and when you zoom in, then you will see you will see a different picture. Okay, so that's the volume spike. That is a very high probability, Srini. When we talk, we should go against sweeps. I think we can say we should go again volume spikes here, or if you want, you can call them stop runs. You should go against them. You should go against them here, because the probability is very high when this high volume is traded that the market retraces or make a pullback, retraces 1, 2, 3 points, maybe more, maybe less, but it's not a loser. It's not a losing trade when you enter this market. And the probabilities, as I mentioned, high of 50%, we have the statistical significance, because volume spikes indicates exhaustion. It's the highest concentration of volume traded during a period of time. A break in the market is needed to find new buyers or sellers. We discussed that. And volume spike settings are, yes, volume spike settings are available for all instruments in TradeFinder. So if you want, if you call them volume spikes, if you would like to call them stop runs, whatever, you can define them here for every single instrument. For Apple, for Microsoft, for, I don't know, yeah, here for HYG, for, let's see if we see some here, VXX, UV as well. See nothing here so far. NQ for sure. No, nothing significant today. I have to adapt other settings here. Oh, that's nice. You see development iceberg here. That's a nice one. We should talk about that when we come to the DIDs here. Let me see. Oh, we see a lot of sweeps here. Oh yeah, we see stop runs or volume spikes here. You see how important they are when they happen. You are alerted that this is really hard volume and the market might retrace at this point. And the statistical probability is really higher than 50%. However, we didn't make any statistical examination based on the volume spikes. It's simply what I have done with Excel, and this is not really complete. No, they don't need order IDs. Volume spikes don't need order IDs. It's simply the time and the volume traded where we want to see where is the exhaustion of the market. It's a kind of market exhaustion. You see volume spikes? Yeah.
Well,
I'm sorry.
Yeah.
I'm sorry. Could you just bring up the NQ chart real quick? I just went to the. So they're on 347 there was a high liquidity that just came in at like around 11:30 Eastern time.
Here or what?
So at 16,347 price point. 16,3. You see that on here?
Here.
Okay, you don't have.
This is the NQ.
This is the NQ, right? Yeah. That's weird. Because I see on the buy side 116 contracts that just came in at 11:30. But you see the market moved away from it. So how do you know? Like how could you give it a good probability? Like how do you know when it's going to go away?
Yeah, that's a good question. That's a really good question. You will never know that. So because what you see here is simply on the stop MVP, which represents the stop tracker here. You see the high volume traded 53 and ended up with 865. Give me a second here. Maybe the settings is really not the best here. Give me a second to see if this is really something where we can work with. The question is always in this, with all these add-ons, what do you want to see? And I'm not an expert of NQ. I think we could adjust it to indicate 500, 400 and 500 and more contracts within a certain time. Therefore, I have the MVP here, the Market Volume Pro, which represents is the equivalent of the stop signal. So let me see, recalculate that. Yeah, it's a little bit better. It's a little bit better. It's not perfect. It's not perfect because the time is very short here. But it's always the contradictive discussion, or the discussion here, how to find the settings here, because it takes 39, 40, that's really, 1 minute, 60 seconds to trade all this volume here. On the other side, when you set this volume to 860 seconds, you will see other signals which are not really useful, and that's the problem we are facing with this mechanism here, you see. So this is not going to work. Let me see if I can add it. Let's do 60 seconds. Generally saying, Julius, the market is, the more effort it must be taken to adjust the signals properly. That's really hard to find every nice sweet spot in instruments, and it's really hard. It's not really something which will show you immediately. You see what happens if you put 60 seconds on. You get a lot of wrong signals here, or false signals. That's
you just scroll to your right a little bit, Walter.
All the way to your right.
All the way to your right.
Keep on going. Yeah.
Keep on going. Yeah. See that there's a liquidity at 16345, right? It came on, and it kind of hit in the. I don't think they even hit it in the beginning, but it's just hovering above that, and then another patch came in, and now how do you know? How could you gauge? What's the problem? How could you be on their side where they just put that liquidity on just to get more buyers to get involved and to drive the price higher versus hitting the liquidity?
My answer would be, I see the order book imbalances. Let me just make this a little bit bigger here. In this case, I see the order book imbalances to the upside, pointing to the upside. I see the order book imbalances pointing to the upside. I see if you want to resist here, this is a sweep, by the way, and we see a volume spike as well here. Trading, that means we should go against the volume spikes. If this is a sell, we should go long. So we have order book imbalances to the upside. We have a good liquidity sitting at 345, and this is another nice signal, this volume spike or the stop run here, and then go long, go long, go long. Now it turns back. We have an iceberg here. And by the way, mind the MVP. The MVP is a market volume indicator, which indicates volume spikes or stop run, however you want to call them. And then you see this, it's green, or it's blue in this case. It's blue, and that means the market is most likely to trade higher here. So that means it's bouncing up. We have several signals. First of all, it shows the imbalances on the upside, pointing to the 16400. We have a good support here. And we have a sell spike, we have a sweep, and we must nothing, but the opportunity and the probability is higher to go long here than short. And to the opposite, if you want to see what happens here at this point, then you should have a look at a QQQ as well. And the QQQ is a little bit more, is much clearer than the NQ here. Let me see, I have to, no, QQQQ, let me see, where's the Q? Here, that's the NQ. So, if you compare, we talked about that, QQQ, what is QQQ doing? It's pointing up, it's pointing up, it's going up, it's going up, it's going up. I don't know whether this is the same time. Yeah, it's, let's see a little bit more inside. There are a lot of synthetic icebergs coming in here. No supportive iceberg so far, but it's rising to the upside under QQQC 400 as a liquidity. I think this is, from my point of view, to say it very, yes, intuitive here. It's pointing to the upside. You have nice signals here, and as well the QQQ is supporting your idea to buy here. So just again, I want to show you that if you have some doubts what to see here, what to do here, we have a high volume trader, then you see divergences, and that's a little bit how to say, contradictive to a long position here, because we see divergences. First divergence, the second divergence here. You see that, what I mean?
Yes.
Just give me a second here. Here, this one. Yeah, roughly. And that was correct at that time. But you know, we can't, at no time, we can't predict any, when the aggressors came in or will come in. We can't predict that. We don't know when the aggressors are joining the market or joining the arena here. So the contradiction against the long is here with the divergence, because the aggressors are, yes, deteriorates here. And on the other side, we have the liquidity, we have the volume spike, we have the pointing up to the upside, the order book imbalances. Let me have a look here. Just another one. No, it's not. Here. Okay, disregard the order book imbalance. It's pointing more down. That's a little bit strange here, so I don't like the NQ. But on the other side, if you don't want to rely on the imbalances, then you must, and I say it really consciously, you must watch the QQQ, because it gives you the clue what happens. It's going up. You see how it's trending. It's going up. You can't, at the moment, there are no signs to sell this market. And I bet the ES will follow, or is following. Not so. Can't say they.
Walter, that QQQ, that imbalance, you can see like absolutely one side. Does that help?
Yes, that I think so, because I have to. I'm not a friend of NQ, so maybe my settings are not the best. I have to review the settings in the NQ and have a closer look to the NQ again. But I think I did a QQQ, and what attracted me is simply because it's a little bit more cleaner. You see the liquidity here at 400, and it points up simply to the. I mean, you don't even need the imbalances here to be open, because you see where the imbalance is very clear here in this picture. It points to 400, so that's the liquidity here at 400. You can have them on chart, but as I mentioned, I would like to get rid of all the signals, because some of them can mislead you. It doesn't matter what you are using. And my first eye catcher is the 400 here, the liquidity here. And the second one, as I mentioned, is the liquidity, which is really strong red. I've got a volume spike here. I got a sweep here, and then in conjunction or together with a QQQ, it is a buy. That's a buy. 55 buy into whatever. Here. These are enough signs to do so, to go long here. Latest here, when this line turns blue, but that's also a little bit shaky, guys. That's something. And you see, by the way, 16,400, it might be the next level here for the NQ. You see how the volume spikes come up here. That was a really small, nice volume spike, and the market exhausted at this point and takes a break before they are maybe continuing the way up into 16,400. Is the V delta stop run part of the market? Yes, yes, it is. I mean, it's literally very, very similar to the stop run part of the SI tracker. I know that because we developed it together. Do you have config settings for European market? No, no, we don't have. We have the settings here on the page, on TradeFinder page. For ES, NQs, let me see, I have to. And I will add more and more and more treasuries, the soybeans, UV, XY, Tesla, CL, HYG, NVIDIA. And it's simply a matter of time. It takes time to find the best settings where we can recommend what we can recommend to do so. Okay, guys. We are now not to lose you. We are in the strategy. We have learned how to get a big picture of the market, of the markets, not only of one market. We are talking about ES, we are talking about NQ, we are talking about Russell, we are talking about stocks and ETFs. It really depends on what you are trading. But what I will show you the ideas. I will show you the ideas what you have to find the sweet spots in the chart. There are many, and it is really not an easy task to find the best one. I will show you that the volume spikes are really promising, good signals. Sweeps as well are extremely good signals. I added absorption, but there's no statistical evidence that they are really working. So from our point of view, we did it on absorption. There's no statistical evidence that you can rely on absorption, that you can't rely purely on absorption. That's really something I would not recommend to watch and to trade. That's my personal opinion on absorption. You can see that, you will see that. That means absorption, the market volume will collide with liquidity or resting liquidity, and the resting liquidity will absorb the whole market or the market volume in this case. Excuse me. So what I'm saying here by this slide, what I'm saying by this slide is there is no statistical measurement available for if absorption is working or not. Absorption is considerable when it is absorbed by liquidity. Yes, of course. We need liquidity to get a meaningful absorption. So the absorption is more meaningful when it happens into liquidity and not somewhere on the chart. I mean, you can find every single small absorption. That means if you want to see an absorption of 10 contracts, you will find them on chart. For every bullet you see on the chart. But that's not what we want to see. We want to find the big ones, the big fishes. We want to catch the big fishes here. Whenever market and limit volume transact, collide volume or energy is taken out of the market for a short time. So the significance of absorption depends on the volume size absorbed. That's what I wanted to say. Smaller absorption is less significant than bigger absorptions. Okay. Yes, we did as well this ongoing discussion, icebergs or not. We can display every single iceberg. It doesn't matter it is a native iceberg or it is a synthetic iceberg. It doesn't really matter. But there's as well no statistical evidence that we can say if we see and trade an iceberg, we will be highly profitable or we will be profitable or we will make money. So there's no, from our point, that by our point I mean I'm talking about our team here. We test back on the rhythmic data we have collected. We have here. Yes, we have collected. We have to use it, and then we have no statistical measurements available. As we discussed, icebergs are important indication, or one part of the chart indications on chart where we can say, okay, there's a liquidity provider, he provides liquidity, or he's taking liquidity out of the market, and we will never know why icebergs are placed in the market. That's not possible. There's no any indication in the order ID, in the data field, in the data string of an order ID, why icebergs are placed in the market. It's simply not possible. We can speculate, we can meet in the pub and have a pint of beer and then discuss the icebergs and the meaningful in the sense. Yes, the sense of icebergs and whatever, but we will never know why an iceberg is placed or not. The only exception I would agree to is that you remember this guy who sold 2,000 yesterday. And when we see an iceberg coming in, let me see, 5 points lower, 10 points lower, of 2,000 again, then we could make a connection, because we know, okay, there was a guy who sold 2,000 contracts, and at the session end, there was an iceberg who transacted 2,000 orders, 2,000 contracts. That could be, yes, that could be he. He simply closed his trade here. That's possible, of course. But if you see single icebergs, if you watch these icebergs here, and it depends on what system you have, keep in mind that Bookmap is aggregating data on their chart. If you see here maybe 50 on Bookmap SI tracker, then you have to zoom in and you will see that the number changes constantly. We choose another approach. When we see 50 traded, then this is really 50 contracts traded at that point, at that price here. So keep in mind, Bookmap is aggregating data, and if you want to know what is what you want to see, then simply zoom in and try to understand what this number or the numbers are you see on your chart. So we can analyze native synthetics, and we can combine both native and synthetics. And as we discussed, I don't want to stress this again, icebergs can be hedging, big orders placed, liquidity providers, liquidity providing, liquidity taking, as mentioned yesterday, that can be everything. Good. Now we are coming to a quite interesting point, which is dividing the trading community to a certain point, and this is the dynamic iceberg development. I think we see. No, Oh yes, here. That's what I wanted to see. I think, yeah.
When you bring up charts like this, can you maybe highlight some areas that you would consider buying and selling?
Sorry, can I highlight what?
Can
you put over your mouse cursor the areas that you would consider high probability places to buy and sell based on your tools?
Now we are talking about the DIDs, or the dynamic iceberg developments. And we found some interesting characteristics of the DIDs, of this dynamic iceberg development, because first of all, someone is placing an order ID some time before. Oh yes, yeah, guys, give me some minutes. I have a medical appointment at 6:30 my time, so just it's not far away, but anyway, I don't want to finish that because I want to discuss tomorrow the trading part and not going through the theory. The last one I want to stress is, thank you, Yves, is the dynamic iceberg development. This is so important, guys, that you should take your time to understand it. Dynamic iceberg development is simply one order ID. I'm talking about market by order data again. One order ID which was placed time before. This is the black bullet with this yellow bullet here. And then market trades against this price 59, and then the price pulls back, comes back to the 59, trades again, and so on. This is what we have hard facts. We did hard facts, and that it might sound very low, but we have a statistical relevance with a right risk reward ratio and risk reward management, that DIDs are highly successful or good successful ideas to trade the market. The dynamic iceberg development, DID, indicates live on chart the intentions of market movers at price levels. When they started to place their IB, their iceberg time is extremely relevant in our strategy. We see whether there are sellers or buyers, how much volume was transacted, and how much volume will be transacted. There's maybe a typo here. And the DIDs are indicated by the by the trade finder. Oh, there must be. I think I did a mistake here. I have just give me a second to. Oh yeah. I mean, you will get an update of the documentation maybe today, latest tomorrow. But there's a typo. There's maybe a additional page here into this slide. Okay, I have to delete that. And that's the backtest based on the data from January to May this year. And it shows a very nice outcome based only we are traded, or the algo was traded only in the backtest, only the DIDs, the dynamic iceberg developments. So that's the backtest. You see the backtest is not straightforward, not straight up. Then we did a stabilizing backtest, and it shows a very mixed picture. We started here, we get in the minus, or the account went minus. Then we have had a lot of some good results here. Then it started again to goes against us, and then started again to rise here. So it's really it depends on the parameters you are using and watching to find a really nice and decent DID which will work. However, this is the forward test based on the data. I have to ask Philip how he did the forward test, and you see that it's rising. The account is constantly rising, but not in a row like a 45-degree graph here. No, it shows winning trades and it shows losing trades. It shows winning trades and shows losing trades. And that's the characteristic why, that's the statistical outcome why, yes, it is ES. Why, I forgot what I wanted to say. This is the characteristic why we should very cautiously and looking for certain DIDs. So there must be, and as described it here, it must be at least 10 seconds in the book, at least, better more. It means it should have, excuse me, I've missed that, duration of how long did the volume of iceberg should be at least 150 contracts, and the stop required must be great and lower at least 9 ticks, not more, and the P must be 6 points. That are the characteristics of the DID. I have to just give me a second. Duration. I'm a little bit under pressure right now. Duration of iceberg in the order book is important. Yes, it must at least 10 seconds in the order. Phil, are you around?
Yeah, sure. I'm
here.
What do you mean by 2? Duration of how long the DID price level is repellent and still?
So we have two, we measured two time frames. The first one is that you mentioned before, which is the time from putting the iceberg order in the order book until the first trade. This is at least 10 seconds. And then we have a second time frame measured as a parameter, which is from this first trade until it reaches the set volume, which is here 150 contracts. The iceberg must defend the price level at least 180 seconds. So that means from the first trade till the 150 lots are reached, it's at least 3 minutes. And the assumption behind it is that you know, sometimes the market, the aggressors in the market are so strong that they absorb the iceberg within milliseconds and seconds. And that means for us, the iceberg is not strong enough to hold this aggression, to defend against this aggression. So we measured this time frame in order to see how strong the aggressors hitting the icebergs, hitting the lots, and how is the iceberg defending and let's say in a sense holding the line. So this is the second time frame that we measured.
Oi, блядь, эти сказки.
Hello?
Sorry?
Hello. Hey, just a moment. Levi, please mute. Okay, Phil, go ahead.
That were the two time frames that we measured when it came to DIT. And to your question before, how we did the back test and forward test. So we measured for a whole year the whole data, MBO from the ES for all contracts. And then we created a huge data set of about, let's say, 1 million simulated trades. Then we took a certain amount of these trades for backtesting, found out some parameters by stabilizing testing, and then took these parameters and tested forward with the rest of the data that was not been used so far. So this was the approach that we took for the DIT parameters, and these parameters were the most promising from a statistical point of view in order to trade an iceberg, or to at least to see when an iceberg, when a DIT is a point of interest for us in our daily trading.
Okay, thank you very much. Questions? Do you have some questions in regard to dynamic iceberg development? Because it's quite interesting to watch it. You know, you will see that on your chart. You will see, I encourage you to have the trade finder. You see, I'm not an expert. I must admit, I'm not an expert in. I'm not an expert in NQ, but what I see here is that we have had an iceberg. For those of you who are trading NQs, is that we have an iceberg here that was 16:24 my time, that is 11:24 Eastern time, which started at 16:21. That means 11:21, and the first part of the icebergs was traded for 3 minutes after the order ID was placed. So the price, the quite interesting part and dynamic of icebergs, you will see and you will learn if you are using Trade Finder. The price was here. You see, the holy grail would be if we can say, okay, this order was placed with the intention to be traded as a part of an iceberg. But you see the contradiction and you see the problems here. We can't, when you see this axis, this vertical axis, then there are thousands and thousands of order IDs along this line here, right? I think it's easy to understand. So how to pick the right order ID? It's impossible. We can only pick the right order ID when we see, okay, this is a refreshing order ID, which was traded here at 11:24 and 80 seconds exactly. And then we can see, okay, this order was in the book 3 or 4 minutes before. it was and set on exactly 16,300 here in NQ. Wonderful. The first part was traded here. So when we see the characteristics, I think Philip, it matches the parameters which are most interesting, because it was in the book for 3 minutes. It traded. Come on.
Yeah, it's the NQ, so the volume is not 150. I think the volume here is fine as well, so this would definitely qualify for us as a point of interest with a very low, with a very high, low risk-reward ratio for us. So yes.
Argo is asking you, did you also create a backtest for other instruments?
Sorry, no, just for the ES. It was it's a lot of effort to do this for one instrument. But yeah, it's a good suggestion. We definitely should extend it to other instruments. But I guess, I mean, now in the NQ you see that it works as well. We saw it in soybeans as well, that DIDs were appearing and were fine. And the two basic assumptions that, the first time frame from the, putting the order in the order book until it's traded first is that this player knows more than others, and he might want to defend this price level. And I think this holds true for all instruments. It's just a matter of volume. How many lots should we wait until for us this is valid? But I guess for this lot size we need to do more analysis. More.
Yeah, that depends really on the volume of the instrument's volume. As I know, every single instrument has his own volume. Every single instrument has its own characteristics. And volume, and therefore it must be applied correctly to see that. We just played around with the NQ here, and let's stay with the NQ just to show you the idea. When you see the right parameters or the parameters are met, then the first reaction is to go long, because it is an iceberg or developing iceberg on ask. This is indicated by this professional view that's green. Otherwise, the opposite of ask will be red. You will see that in the book, and when it develops, and that will be the first idea, and it works, guys. It works really well. You have to maintain your risk-reward ratio extremely strict. So we will try it with an algo which simply trades what we have defined, and then the outcome will be a positive return over the time. We will discuss it tomorrow as well. Hopefully we will see some. Maybe we can trade even, or I will trade them if we see something here, right, like a DID in the book. And it's extremely exciting to understand the intentions of these players here. He is still setting on 16,300. He's still sitting on 16,300, and as I see in my VIX charts here, VIX is rising. I suppose the NQ and ES will trade back. Let me see that. Oh, come on. Yeah, that was a very nice pull back here, and he is still sitting on 16,300 here. Interestingly, maybe that the market is he is still waiting. That means either he is right, and he expects the market to come back to 16,300. We will see that maybe at the end of the day. And if the theory is right, it might be that the price comes back from 16,400 into 16,300, and then we can say, okay, this is a well-informed trader here at 16,300.
Basic question, Walter. If you go to the left, the blue dot and that big white, big yellow one. I'm sorry, I might have missed yesterday, but what's the significance of the blue dot? First one, it starts with the dark one, and then what is why it became that big one, big yellow?
Yeah,
the dot.
that's. I think it's not a blue; it's a dark black one, but it doesn't matter. This is the beginning of the iceberg. That means at that time there is at that time 11:21. He started. No, the order was placed at 11:21 in the book, and the price traded against the refreshing iceberg at 16,300 at 1625.
That means the iceberg got it fired again.
The iceberg was
right?
Sorry.
Iceberg fired again. It means it placed
Yes,
some order,
yes.
whatever the extra
Yes, but
orders.
it was placed
Yeah.
5 minutes before. This order ID, the special order ID was placed 5 minutes before, and that means if this order was placed 5 minutes before, that means he waited 5 minutes. And look what you know what the conclusion out of this mechanic is. Look here, the price was here. Every one of us would have thought at that point, okay, the price goes against 332 or 405. That is our conclusion. But we don't see naturally we don't see the point here. It would be great if we could that, because this is really then the Holy Grail. That's really the Holy Grail, guys. But we can do that. No one can do that. It's impossible. So what we are indicated, the iceberg was traded first time here at 16:25 or 11:24:20 Eastern time, and the second time it was traded 11:24 and 43 seconds here. That is the second. You will see maybe more than 1 or 2 or 3 yellow points.
Why the dot is small?
Because
What's the significance of that?
it is a traded volume, because the traded volume was small.
Oh, the small. Okay.
And that was a big volume, therefore the yellow dot is big, and that was a small volume, therefore the yellow dot is small. Let's see at the ES. I think.
Right now something is
Oh,
very interesting
look
happening.
here, guys. Yeah. Look here. What a nice. I think Philip would say that's a buy. I can't buy it right now. I'm sorry, guys. But that's a fantastic example. So the iceberg is executing at with stop runs here. With absorptions. Absorptions here at 89 even. A second one comes up here. Or is it no? We have a quite interesting situation. We have to discuss it right now because it's real life. The first part of the iceberg was traded was hit at 12:08 Eastern time. The order was placed in the book here, and you know what this means. I mean, there's for sure not many explanation or big explanation required. So we looked all the time. We have to go long because the VIX was down, and there was maybe liquidity there. By the way, guys, if you want to watch this, there was a price alert line or institutional line at 96. So I think it was this one. Look here where the price went to. And finally, look here, 2,000 contracts. Do you remember what we mentioned yesterday? 2,000 contracts. The guy who swept the book. Maybe. Let's speculate. I'm not sure. It's gone right now. I just wanted to show you anything else. That was one which was really interesting to trade, and it was traded finally with 2,000 contracts. Let me switch on the hidden orders and see what happens. That was an iceberg traded exactly at 89. That means if he was short 90, he got 1 point. just an idea how to see the market here. Then he traded, there was nothing left. He traded a full size of 2,000 contracts within 1,894 seconds. Amazing. You remember yesterday where there was a big guy who swept to 2,000 contracts, and now we see an iceberg of 2,000. If this is he, then he got 1 point out of his trade. But that's simply an assumption, nothing more.
Did the iceberg end, Walter, here? That with the 2000?
Yes, it ended. It ended. It started 1,894 seconds. That was, I don't know, here some before. It was too fast, so I was simply too slow. And it ended here. It was transacted at 88 here, and finally traded all 2,000 contracts at 89 here. That was the line 89. He traded and got every single fill. I mean, these are algos, you know. This is not a single individual who is sitting behind the screen as we are sitting here and calculating. Okay, maybe that's the area where I can get 2,000 contracts in a row to cover my position. This is all algo driven. That we don't have any influence on that, and that this iceberg could qualify for a long position. It might work maybe for 1-2 points, but then it came back and then broke down here. That would be yes, on the false or losing trade. Maybe they're coming back here through this 89 and trading higher then. Yes, 90 stop loss bridge. Extremely interesting, guys, what we see here. I hope we will see some quite interesting situations tomorrow. So just to remind you, the statistics shows that the total win increases over a period of time. That's not said if you are trading DIDs every day that you will be successful. As Philip mentioned, not every DID is profitable, and drawbacks in a row can happen, so that you trade one, every parameters is well and good, then you will see drawbacks. A consequent and high and tight risk-reward ratio must be maintained. Maximum loss are 9 ticks, and maximum gain should be 6 points or more. Sometimes they are really fast when you get more than 6 points, and this will rebalance the losses. That's the outcome of this test here. What we should keep in mind when we see that, because this is all real time, this is nothing lagging, this is what the market is telling us, that we can see these levels as the DID levels as resistance and support levels, and the DIDs will be described as point of interest. As you see here, that was the point of interest to trade, because let's say he swept 2,000 and he's buying back 2,000. That was the point of interest for him, or for the algo. Which was just tracking the market and seeing if he sold 2,000, maybe he want to buy back 2,000 here. That's a point of interest, definitely. So we should have a look at in combination with additional liquidity, hidden liquidity changes, the institution levels as well, and the volume spikes and sweeps if they happen on the way around this dynamic iceberg developments. Okay, timing, volume of the DID and his behavior while being traded plays a major role for the trading strategy. Parameters must be adjusted to the average liquidity and average volume of traded instrument. Price dynamic plot, we talked about that, but I would like to make a break here until tomorrow because we have the price dynamic plot and we have the business done pattern. There are only 2 patterns just to discuss, but I would like to postpone it tomorrow. I would like to suggest following. Because I have an urgent case here, I must leave within the next minutes. We will be together tomorrow at same time, 9 a.m. Eastern time. And I would like to ask you to reserve your time or to take time until the market ends. That means from 9 p.m. to 4 p.m. 9 a.m. Eastern time to 4 p.m. Eastern time to recap everything we have discussed here. I think this is overwhelming information. But what I want to do and to think about that tonight, this afternoon, your time, tonight for the European guys, is to recap this detox suggestion. This is the detox suggestion because it happens, you see, in real time. You don't need any other indicators. You have the stop run indicator here, if you want to call that this way, the V delta or MVP. And that's another one good try to go long here at 85. So, ladies and gentlemen, tomorrow 9 a.m. Eastern time, as well 3 p.m. European time for those who are from Europe. We will recap all what we have discussed this week, and we will do a day from 9 to 4 p.m. Eastern time together in the market. Maybe that we are running in a choppy state, but it doesn't matter. We have enough to discuss. Please keep your questions in mind. Use your microphones. Discuss tomorrow because it's our last day in the seminar, and we will continue maybe in the room if you want to join the Discord room. When I'm available and my team is available as well to discuss all this stuff together and all this knowledge what I've tried to tell you, and then let's see what happens. What happens next? I just want to again to say, think about the detox week. It will do a very good job for you, and then you can come back. Whatever you want to do, you will see that might open your eyes a little bit because it's really fantastic. All this stuff what we are discussing here is good. You should know that. You should keep that in mind. It's not possible to keep everything in mind, and but anyway, you have the really good foundation now to trade on your own without the help of others. That's the point.